What's going on? Welcome to another video. My name is Tom, a former financial analyst, now a full-time YouTuber. And in today's video, I want to talk to you about NNDM, Nano Dimension. How the stock price have been going berserk. In the past month, the price literally doubled. That is insane. Now, what I decided to do based on what I just saw is go deep, dive in, analyze the company, and answer one simple question. Is this company overhyped and overvalued, or is it extremely disruptive and a good opportunity to get in early? Let's do it. Now, let me be honest with you. I'm not going to give you a binary answer to this question. There's not going to be a bad or good rating for this company because there's a lot of positives here and a lot of concerns. And I'm going to point it out to you. I'm going to show you everything. And the way we're going to answer this question is by using my own method. We're going to take a look at the financials. We're going to take a look at the quality of management. Of course, we will do our evaluation overall of the company. And most importantly, since you guys liked it so much, we're going to do a full detailed DCF, a discounted cash flow valuation, to evaluate the real price of the company and the target share price, which I think is fair based on what we know now. So first of all, let's set the record straight. Let's talk about what this company is, and most importantly, what it isn't. Now, the company is not yet a major player in its industry. You have to understand, there's no real money there, there's no profits. It's a pre-profit R&D early stage company. Whatever it is you're buying now, it is straight up potential. And there's nothing wrong with buying potential and buying upside, just as long as you are aware of that. And you know what? Because there's so much potential baked into the current price, we have to explain what this company does in order for you guys to actually understand what that potential is, so you can make a decision whether you want to invest in the company or not. In any electronic device you may hold in your hand, starting from these AirPods all the way to your phone, anything has electronics in it. And that electronics is driven by a brain. That brain is called a PCB, a printed circuit board. They come in all shapes and sizes like humans, and they can be flexible or fixed, large or small. A PCB is essentially the backbone of any electronic device you can think of, your remote control, of your TV, anything. And so far, if you wanted to create one for a brand new product, the process is extremely lengthy and extremely expensive. Let me explain why. First of all, you have to take a guy and sit him in front of the computer to plan one. It's like a roadmap. He has to design one, plan one, and get it out of the computer, put it in the hands of a factory that does small quantities, does samples. Now, these samples, as you know, are expensive. And also, they take a lot of time to get back and actually try them out. And more often than not, these don't exactly work for the first or the second or the 10th try. It's going to take you a lot of back and forth until you get it right. And this whole process of going back and forth with your small quantities fabricator can take weeks or even months and can cost you a lot of money, because people who make samples don't work cheap. It just makes sense. Now, here's the thing. Once you actually go big, you can go out and outsource this to China, and they print tens of thousands of these PCBs once you have your shit together. But before you do that, you have to develop it. And the development is a lengthy and expensive process. You're also exposing your technology to somebody else externally. You don't have control. It takes a lot of time. It's not very streamlined. Now, what these guys actually did is actually very funny, because they use a very old business model to apply to a cutting edge technology. And I think it's amusing. So as you know, if you have a printer in your house, how do the printer companies actually make money? They sell you ink. The money is not in the hardware, it's in the disposables. Now, these guys have actually taken this old age model and applied it to a brand new cutting edge technology which nobody else has. Now, here's the thing. They've designed a device which looks like a printer. You put it on your premises, and then you can design your own PCBs, print them out, test them out, and do it again and again as much as you want. You don't have to send it out. You don't have to pay to anybody. You do it on your premises in real time. So it's faster, cheaper, safer, whatever. However, the way they make money is not by selling these machines, is actually by selling the ink. They use a proprietary ink for this 3D printing. It actually is the business model. So we know the business model is proven. Every single company that does R&D would love to vertically integrate PCB manufacturing, because this is so costly, so wasteful as far as time, and just unsafe as far as protecting your IP. So to buy a machine to allow you to do a PCB on your premises in real time from now to the next few minutes, it's insane. So for these guys to put a machine on their premises that can actually design and fabricate PCBs in any quantity at any time in real time, it's unthinkable. It's revolutionary. It's disruptive. For this part, you can't argue the company actually has done something phenomenal. However, there are warning signs. Now, this company has not sold a lot of these so far. In fact, they only sold 60 machines. That's not a lot. So you have to understand how early stage this thing is. Beyond the fact that we know ARK is invested in this company, which is always a good sign, but you have to remember ARK are not gods. Not everything they invest in turns into gold. Even though I like Kathy, shout out to ARK, but not everything they invest in is automatically great. So you know what? Let's put everything on the table. Let's do likes and dislikes, like old-time dating profiles on these websites from the 90s, right? So what do I like about this company? I like the fact that they're disruptive. They have a technology which nobody else has, and it truly has the potential to revolutionize a whole industry. Not only for R&D, but also for small quantities. The machine can actually put out thousands of these PCBs quite quickly. So we're not talking about mega production, but anything in the small quantity area, these guys are revolutionary. Second thing I like, ARK Invest are invested in this company, which is always a good sign. However, for me, ARK are not gods. Not everything they invest in is gold. So for me, it's a nice sign, but nothing more than that. I also like the fact that they put in $80 million in R&D just in the past 5 years. I also like the fact that they have a lot of cash. They just raised a lot of money, right now sitting on $400 million. For a company this size, it's a lot of cash, a lot of runway, and I like that. I think the market is phenomenal, a lot of upside. I just took a look. The global PCB market is headed to $75 billion in 2025. It means there's a lot of meat on the bone, a lot of skin in the game. It's very good. I'm not going to do what a lot of people do and say, hey, if they just capture 2% of the global market, it's 1.5 billion in revenue. I mean, that's stupid. If you hear that sentence from anybody, you know that dude is a doofus. It's really hard to capture 2% of anything global. So hold your horses. It's not that fast. Now, the thing that concerns me about this company is how early stage that is. The company still just sold about 60 machines. That's it. They're much, much earlier than people understand. It's an early stage pre-profit R&D company with a lot of upside, but also a lot of risks. You can't discount the fact that this company is very early stage. And with any early stage business, there's a lot of risk, a lot of uncertainty, and there's nothing guaranteed apart from two things. Number one, we're all going to die at some point. Number two, we're all going to pay taxes. Anything else is uncertain. And the further you go from sales and actual profitability, the bigger that risk becomes. And for this company, we're looking for at least 3 to 4 years until they actually get grown up. And for that, I'm kind of concerned. Okay, so let's run through the DCF. Now, this DCF is going to be a little bit different than the other US companies because this is not a US company. So I'll show you that in a second. So first of all, this is their EBITDA. Now, as you see, it's a young, fresh company. I'm not expecting any positive EBITDA until 2024. That's just the way I see this company going. 2024, we have 5 million in EBITDA. Then we have 10 million. Then we have 25 million. Now, the way we get to the 25 million is very interesting. It's not a made up number. We did a 10% revenue all the way to 250 million revenue. And that means it's about 0.3% of the global PCB market. So 0.3% of the global PCB market in 2026 gives us a 25 million EBITDA. Now, this is quite interesting. The tax rate for this company is very different than what you guys know. The standard tax rate in this company's country, which is Israel, is actually 23%, which is about 2% higher than the US. However, this company, to the best of my understanding, is utilizing a special permit to only pay 12% tax because they are subject to certain exemptions and benefits because they're doing R&D and such. So based on my understanding, their special tax rate in their country is only 12%, which is really beneficial for their evaluation, which I'm sure a lot of you didn't know. Now, there's more. Now look at this. We have after-tax net working capital. This time we actually subtracting CapEx, as you can see here, and the free cash flow. Now, why am I back to 12% discount rate? This company is located in a part of the world which has a lot of issues, a lot of risk, more risk than a company from Delaware, for example, right? The other thing is you have to understand that Israel as a country has gone through a lot of political turmoil. I think they went through 3 or 4 or 5 elections in the past year and a half or 2 years. There's a lot of political instability. Laws keep changing. There's a lot of issues, not to mention security issues, defense issues. I mean, there's a lot of stuff in that part of the world that increase the risk. As much as I have love for everybody, it's not a political statement. I'm just saying there's more risk for a company located in that part of the world. I have to raise the discount rate back to 12%. Also because their interest rates are higher than in the US, so it's not 0% like for US companies. There's a lot of different reasons, but I personally think it should be 12% for this specific company. Now, I don't know what I'll do for other companies, but right now this is 12% for this company. Then we have the present values, and let me show you what's going on here. Now, this is the DCF value of the company, which is 718 million. Hold on. This is not the final one yet. Then we have the EBITDA multiplier, the 25 multiplier for the EBITDA. And then we have 514 million. Usually we'll go directly to the valuation, but hold on a second. This company raised 400 million in Q4, meaning we know about this number. We know they have 400 million in cash, but we can't see it in the current financial because they stop at Q3. So what I did here is I added it through this point. And that creates a negative debt because the company has zero debt and it has 400 cash minus all the liabilities. It's a negative 390 debt, meaning the negative debt creates more value. So that also will get added to the valuation. And now let's look at the actual valuations. So first of all, this is the EBITDA approach. The EBITDA multiplier means the company is overvalued. 900 million versus the 1.22 valuation it has right now, meaning it's overvalued by 300 million. This is the share price I'm getting here, 6.9. Now, the actual DCF valuation shows me 1.1. Also, the company is overvalued, but only by about 200 million, giving me a price of 8.5, much closer to where it is right now. And this is actually the average, which is a cool billion. We can make it right now because I haven't done the calculation. We can just use this number and actually divide it by the amount of shares and see what price we get on average. So on average, between these two approaches, we get 7.76. So as you can see, based on this DCF, the company is slightly overvalued. I actually only tend to look at the DCF valuation. So for me, it's 8.5. That's the number I'm seeing. Now, for me right now, it's getting FOMO. Because if you take a look at the patterns right here, you can see it's a huge spike just in the past 5 days. And now it's correcting back. As a long-term investor, I'm a conservative guy. This company may go crazy, might lose a lot of money, who knows? But I will never FOMO myself into a deal. For me, this is at $8.5 to $9 right now. I'm going to wait and see what happens next. Maybe it will go up as more news come out, more performance comes out. Let's see, but this is where I'm at right now. Let's take a look at their financials, and this is the Q3 numbers. Now, you might notice they have only $21 million in cash. That's not accurate for two reasons. Actually, they raised about 350 million more, but also this is also cash. When you see bank deposits, it's just cash, but it's cash they can access immediately for a bunch of reasons. For example, you sometimes lock up cash for 3 months, 6 months, a year to get a better interest rate. So it's cash, but not clearly immediately accessible. So it's 38 million plus another 350 that they raised. For me, 400 million in cash for a company that's currently valued at 1.2 billion. It's a lot of cash. They're sitting on a pile of cash. And that kind of cash is, first of all, going to give them a long runway, no stress. They won't need any debt, and they can choose what to do with it. They can ramp up. They can add more staff, more R&D. There's a lot of flexibility that goes with having so much cash with such a small operations. So first of all, that aspect is quite impressive. The other is actually liabilities. There's no debt. This is $1 billion company, whatever you want to say about the valuation, that has no debt, zero debt. It's very impressive. To get all the way to actually millions in revenue and a lot of investment, 80 million invested in R&D based on equity alone without any debt, you gotta be impressed by that. This is very rare, and it shows me that these guys are cowboys. I love that. Zero debt, very impressive. And if you take a look at the revenues, you see they took a massive hit. They went down from 5 to 1.4 just for the first 9 months of this year versus last year because of COVID, and I get it. They're definitely impacted, no doubt, but don't be misled by these numbers right here. You see a lot of G&A expenses, 16.8 million, and then operating loss of 27 million. These are not Dan Bilzerian numbers. This is not Ignite. The reason why you see these is because this company actually had a lot of share-based compensation, which means options and equity compensation. These are not cash flow items, but they're very smart and they're very important in this industry. Think about it this way. They could have spent $20 million on giving employees bonuses or salaries increase and whatnot. But if you do an equity distribution, what you do here, first of all, you don't spend any cash, but you're creating a sense of companionship. You make the company the employees. Now they're part of it. They own more of it, which means they're more invested in the success of the company, much more than another 10% to their salary. So it's a brilliant move. I like it. Don't get misled by these numbers. They haven't lost 27 million in the first 9 months of 2020. That's just an accounting thing. It's not a cash flow item. And if you take a look at the fundamentals here, they have about 40% of gross profit on these machines right now. This isn't really gross profit. Selling 60 units says nothing about your profitability. This is not scaled up. This is not ramped up. These are glorified samples that show proof of concept, but definitely not anything about the profitability of the company. This company is so far from profitability. I'm not even going to look at it because it's irrelevant. For me, the importance is how good the market is, and it's great. How much potential this development has, a lot. How conservative they are with numbers and cash, very. And having considered all that, I'm going to ask myself a simple question. How much the current price is removed from all that? How much of it is actually FOMO, and how much of it fundamentals? Well, about $8.5 to $9 of it is actual fundamentals. Anything beyond that is FOMO. Not saying you can't make money on FOMO as a day trader or swing trader, but for us, if you're a long-term investor, value investor like me, that's not really a good deal at anything above $9 unless we have more information and more updates about this company. Especially once we see the Q4 numbers, it's going to be much simpler to see where this company is headed. I have a good feeling about it, but not at anything above $9.